While the scorching summer continues to roast several major cities in the US, it's also hotting up at Wall Street. The S&P 500 index notched its fifth winning month in a row this July, taking the total gains to 21% in the first 7 months of 2023. That's as cooling inflation and resilient growth encourage investors to pour more money into stocks. The rally has mainly been driven by the so-called Magnificent Seven, a group of companies favored for their defensive and growth qualities. The seven-member group account for nearly a third of the index, which tracks the biggest 500 US companies by market valuation. Shares in Nvidia more than tripled in the 7 months through the end of July, making it the top gainer among the group. The chip giant is considered to be at the center of the hype around artificial intelligence, thanks to its high-powered graphic cards and server products. Although the lion's share of gains was concentrated in a few large stocks, smaller companies also found their seats in the profit train.
And we're starting to see the rally broaden out beyond just a couple of names, which can be a bullish sign once you see the breadth of the market, get above those 200-day moving averages. So it's an encouraging sign for investors that are looking to see this rally sustain itself. And for the bears waiting for the recession, it's growing more frustrating by the day.
Despite the US Federal Reserve's most aggressive tightening policies in decades, investors increasingly believe that the world's largest economy may experience a soft landing. Fed Chair Jerome Powell says economists at the central bank are no longer forecasting a recession after GDP grew by more than an expected 2.4% in the second quarter. Economists at Bank of America have also scrapped their projections for a recession in the US, becoming the first major Wall Street bank to reverse its call. Meanwhile, inflation slowed to 3% in June, making the lowest annual rate since March 2021. That's further easing pressure on the Fed to continue raising interest rates. But stocks got off to a bumpy start in August after Fitch downgraded US creditworthiness from the top AAA rating to AA+. In a statement, the rating agency cited possible fiscal deterioration over the next 3 years as well as a growing government debt burden. The move comes despite the resolution of the debt ceiling crisis in June after a bipartisan agreement to suspend the government's borrowing limit through 2025. But the decision has sparked a quick response from the White House. U.S. Treasury Secretary Janet Yellen said that she strongly disagreed with the downgrade, calling it, quote, arbitrary and based on outdated data.
Over the past few years, the American economy has seen an historic recovery from the depths of the pandemic downturn. Over 13 million new jobs have been created since January 2021. Our unemployment rate stands at 3.6%, near historic lows. Overall annual inflation has declined every month for the past year, and our economy continues to grow. In the longer term, the United States remains the world's largest, most dynamic, and most innovative economy, with the strongest financial system in the world.
Several analysts say they expect the rating cut should have a limited impact on equities, increasing hopes that the profit train may keep chugging along. Khurrum Khan, TRT World.